Hey everyone, it is Julie here with TipRanks, and today we're taking a look at some of the best rated stocks of the past week. So let's get into it. All right, guys, welcome back. Thank you all so much for being here. Today we're taking a look at some trending stocks, specifically the best rated stocks in the last 7 days. So these stocks have all been picking up dozens of Wall Street analyst ratings lately and come in with a strong buy consensus. We're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We found today's companies over on the trending stocks page on TipRanks. Found underneath research tools, trending stocks will show you the best, most, or worst rated over the last 72 hours, 7 days, or 30 days. You can further narrow it down by market cap and sector as well, and get our list down below. And as always, just before we get into our 3 stocks, this is a friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Let's dive right into our best rated stocks of the week. First on the list today is Spotify. They trade under the ticker SPOT, currently priced at $322 per share. In the past year, they've climbed an incredible 115%. In the last 3 months have gained 15%, cooling off here in the last few days. They do score a 10 out of 10 on the TipRanks Smart Score, with very positive crowd wisdom and increased hedge fund activity. Hedge funds have increased their holdings by 1.9 million shares in the last quarter. Spotify is the world's most popular audio streaming subscription service. They service more than 626 million users, including 246 million subscribers across 184 markets. They generate their revenue from premium and ad-supported segments, providing high-quality streaming access to music and podcasts. Their platform is home to over 100 million audio tracks with more than 6 million podcast titles and 350,000 audiobooks. Spotify is trending on Wall Street following their Q2 earnings report last week on July 23rd. The company did come out with an earnings beat and some solid subscriber growth. For their Q2, they reported earnings per share of $1.45, beating expectations by 31 cents per share. Revenue was up 20% year over year to 3.8 billion euros. The company saw their subscribers grow 12%, and they had record high gross margins, which was up 510 basis points to 29.2%. Spotify has received 25 analyst ratings in the last 7 days. One of the most recent came in just today from a 5-star analyst at Phillips Securities. They noted their strong quarterly results, saying that the first half of the fiscal year's performance, accounting for nearly half of the projected annual revenue and 2/3 of the expected PATMI, indicates a strong financial trajectory. They're optimistic about Spotify's robust growth in premium revenue, attributable to a significant increase in subscribers and a strategic rise in pricing. The company's ability to raise prices while maintaining low subscriber churn is a testament to its market dominance and pricing power. With 28 analyst ratings altogether, the Spotify stock does come in as a strong buy with 22 buys, 5 holds, and 1 sell. And the average price target comes in at $392, implying an upside potential of over 21% from current prices. Looking at some of those recent ratings here, we do have a lot of analysts increasing their price targets. Our high end comes in at $460 from Pivotal Research, which would be an upside of over 42%, while our low end price target is a sell here at $230, which would be a downside of 28%. For our second best rated stock, we're taking a look at Baker Hughes. They trade under the ticker BKR and are priced at $38.21. In the past year, they've climbed 9.5% overall, gaining 18% in the last 3 months and continuing to climb this past week. They also score a 10 out of 10 on the TipRanks Smart Score with very bullish blog sentiment and hedge funds increasing their holdings by 7.7 million shares last quarter. Baker Hughes is an energy company that provides a portfolio of technology and services worldwide. As one of the world's largest oil field services company, they provide products and services for oil well drilling, formation evaluation, completion, production, reservoir consulting, and tubular running services. Their 2 main segments include oilfield services and equipment, which provides products and services for onshore and offshore oilfield operations across the life cycle of a well, plus their industrial and energy technology segment, which combines a broad array of domain expertise, technologies, and services for industrial and energy companies. Baker Hughes also recently shared a quarterly report with their Q2 results coming out on July 25th. For their second quarter, they reported earnings per share of 57 cents, beating expectations by 8 cents per share, and revenue came in at 7.1 billion, which was up 13% year over year. The company had orders of 7.5 billion, and their net income attributable to the company was 579 million. The stock has had 14 analysts weigh in the past 7 days, including one today coming from a five-star analyst at JP Morgan. They maintained their buy rating on the stock, saying that the company has restructured its organization and appointed key leaders, leading to more consistent operational and financial performance. Their strategic moves, spearheaded by CEO Simonelli, have been successful in renovating the leadership team and driving better results compared to the legacy organization's occasionally inconsistent performance. They said that the company's capacity for growth in mature asset solutions and confidence in achieving future EBITDA margin targets reinforce their favorable view on the stock. With 17 current analyst ratings, the stock does come in as a strong buy based on 15 buys and 2 holds. And the average price target comes in just shy of $43 per share for an upside potential of over 12%. Looking at those recent ratings, once again, we have quite a few analysts bumping up their price targets. Our high-end price target comes in at $50 per share for an upside of over 30%, while our low-end price target is a buy rating here back from earlier in the month with a pretty flat price target. If you've made it to our third stock today, this is a reminder to make sure you hit that thumbs up button. Our third best rated stock of the week is ServiceNow. They trade under the ticker NOW, currently priced at about $808 per share. They've climbed over 38% in the past year, including 16% in the last 3 months, and jumping up a bit here this past week. They score a 9 out of 10 on the TipRanks Smart Score, with bullish blogger sentiment, very bullish news sentiment, and positive technicals. ServiceNow is a software company providing enterprise cloud computing solutions. They help companies manage digital workflows for enterprise operations. Their cloud-based workflow automation platform enables enterprise organizations to improve their operational efficiencies by streamlining and automating routine work tasks. They offer their solutions to various sectors, including healthcare, education, oil and gas, government, technology, and financial services. And as you may have guessed from that jump up on the stock chart, they did also report an earnings beat last week for their second quarter on the 24th. For their Q2, they reported earnings per share of $3.13, beating expectations by 30 cents per share. The company had subscription revenues of $2.542 million, representing 23% year-over-year growth, and they exceeded guidance across all of their top-line growth and profitability metrics and raised the 2024 subscription revenues and operating margin guidance. We've seen 24 analysts reiterate ratings on the ServiceNow stock following that earnings report, one of them being a five-star analyst from Goldman Sachs. The analyst said that his positive outlook is supported by the company's performance, which includes a subscription revenue growth that exceeded not only the company's own guidance, but also the consensus estimates. The buy rating is also influenced by ServiceNow's guidance for future performance, which remains robust despite a cautious approach to early renewals. They acknowledge the company's healthy commercial activity and a solid public sector pipeline as key drivers. ServiceNow comes in as a strong buy with 29 current analyst ratings, breaking down to 27 buys, 1 hold, and 1 sell. The average price target of $870 would imply an upside potential of 7.7%. Looking at our list of recent analyst ratings, once again, we have a lot of analysts bumping up those price targets. Our high end does come here from Wells Fargo at $935, which would be an upside of over 15%. Going back a bit further, our low-end price target is a sell rating here from Guggenheim at $640, which would be a downside of 21%. So that is a quick look at some of the best rated stocks in the past week. Let me know your thoughts on these companies and if they've been on your radar lately. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you're sticking with your own investment plan. Thank you guys so much for watching. I hope you have a great day, and I'll see you back here next time.